Electric car. Keep it very simple. If you've got the same situation as our friend over here and you're a sole trader, do you pay company car tax? See, after they've seen how you and I have worked together, nobody wants to answer a question out there. Yeah. That's not my fault, by the way. Yeah. Okay. Did someone say yes or no?
Yes. So again, what's the question?
If you have a sole trader business, do you pay company car tax?
If you use it for personal, then you do, I think.
Okay. Do you want to phone a friend, or are you sure? You don't sound too convincing.
I think you do, yeah.
You do?
Yeah.
I think that you can't claim whole of the car against your tax if you are self-trader.
That's right.
It's only a proportion, and you have to define the proportion.
Yeah, so if you're a sole trader...
Reasonable, but I don't know what reasonable is.
Have a think about it. If you're a sole trader, partnership, or a limited liability partnership, you work out how many miles you drive for business purposes and personal purposes, and let's say you drive 10,000 miles a year, 8,000 business, 2,000 personal, and your expenditure on your car is £10,000 a year, and as you've said, you'd claim 8,000 through the business, 2,000 you don't claim. So you don't actually pay company car tax, but you don't claim the entire expense. It's nice and simple over there. If you have a company car, you've got to pay company car tax on the list price of the car and the CO2 emissions. It gets very expensive, in which case you're better off charging 45 pence per mile for the first 10,000 miles, 25 pence thereafter. Okay, that's better for you. But James, for your purposes, if you have an electric car, run it through the company, and you only pay 2% company car tax, which is really, really, really low, by the way.
That's on a low emissions.
Limited company, yeah.
How about a low emissions hybrid from the 42000?
The rates vary. Then that could be, say, 7%, for example. Okay, so go for a fully electric car. Yes, that's through a limited company, and the company pays for everything. So if it's in a hire purchase, it pays for the monthly costs, wear and tear, insurance, repairs, maintenance, MOT, whatever it needs, road tax, okay, all that kind of stuff. Everything goes to the company.
Is that 2% fixed? So if Rishi decides in budget at the end of the year it should be 20%, is that 2% fixed if we got it before then, or does it then go up?
It then goes up, but that would go up in a couple of years' time. So Rishi wouldn't change stuff straight away.
2% of what?
2% of the car value.
Okay.
So
one big lump sum, or so let's say I bought a car for.
No, you can pay it through your payroll every month.
Oh, okay.
Yeah.
Right.
So if it's a £50,000 car, you're paying 2%. Yeah. So it's a very small figure. Yeah, like £1,000 or whatever. Yeah. So it's really tax efficient to have an electric car through a company. Yes, sir.
What if you were charging your electric vehicle at your house? Would the company have any? Could you reclaim any of the electricity?
Yes.
Yep.
Yep. You can do. Yep. Because the
You have
cost.
to somehow record how much and apportion that.
Yeah, that's right.
Is there a max value on the car that you can purchase?
Taken or something.
No.
No. Get whatever you like.
No, I've got
Wholly and
It's
extra.
like 50, 60 grand. What
Tycoon's 156.
Yeah.
I used to have a Rolls-Royce Ghost, £385,000. I think Mark Homer's got a Lamborghini. Yeah? Other people have other cars, by the way. Sorry?
That's not electric though. It's Lamborghini.
No. Of course it is. Yeah.
Battery in it, it's electric.
The point I'm making about there's no limit on the value of the car. So have whatever car you like, as long as the business can afford it. Yeah? Happy with that? Happy with that, James? Okay, that's that bit done. Let's now do, so we've done that. Home, PPR, CGT. There's a question from David over here, and I think you wanted to contribute.
Supplementary, yes.
Supplementary question, okay? So your scenario that you laid out is you have your main residence.
Yeah.
That person then moves out and buys a new house or home.
Yeah.
Okay? Are they going to sell the first one or keep it?
They're going to keep it while they're refurbing the house they're moving to.
Yes.
So how long have they got to do that refurb and move in, and then do something with the first main residence to minimise the tax liability.
Okay.
And then the second part of the question was then if they wanted to then keep that but then transfer it into a company, for example, would that be the right thing to do, or would it be better to keep it in
Okay. So if David has his own home and buys a second property, he has to pay an additional rate of stamp duty land tax. Does anybody know what that percentage is?
3%.
3%.
4% depending on the country. Wales
Yeah,
is 4.
yeah. So 3%. And if David pays the 3%, can he reclaim that back at some point in the future?
Yes, if he sells the original home within, is it 18 months or 3 years?
3 years.
Okay, got it.
So you've got 3 years to sell that house. Okay. If the house is empty, you're okay. If you rent it out, then you might have to pay some capital gains tax. But the longer you've owned it for, the less likely you'll pay capital gains tax, as long as you've lived in the property to the entirety of ownership, David. Okay? If you don't want to sell the house to a third party, you can sell it to your limited company or to a limited company, still get the 3% back. However, when the house moves to a limited company, the limited company has to pay stamp duty land tax on the purchase. So that might negate the benefit.
Unless you do your magic thing with LLPs and...
You can do, but you need more than one
Yeah,
property to do that.
got it.
Does that answer your question, or was there something more in particular you had, David?
No, so it answers my question. So is there a potential, if you keep it for if you sell it within 3 years, the initial place, does capital gains tax kick in before? It still classed as your main residence.
You sell it within 3 years,
Yeah.
then you can reclaim the 3% SDLT that you paid on the second purchase.
Yeah.
Okay? With capital gains tax, it's worked out. So let's say you've owned a house for 100 months.
The second one, the first one.
First one, okay, and you've lived in it for 100 months, no CGT. Yeah. Let's say you've owned the house for 100 months and you've lived in it for
30 years. 30 years.
There's a big difference between 100 months and 30 years, by the way.
That's my supplementary question.
By the way, now I know where you're coming from, by the way. We're on the same page. David, do you want to move over here? I'm sorry it took me so long, by the way. So, we'll stay with 100 months, okay? 30 years gets too complicated for my mind. So, if you've lived in the house for 91 months, you get the last 9 months tax-free as though you lived in the property. Okay? That applies to you whether you live in the property or not. It used to be 36 months, 36 became 18, 18 became 9. Okay? So if the house is empty for, say, 36 months, and then that's part of that, you'll be okay. If you rent it out, okay, then 36 and into 100, which is 36%, you work out what your gain is, and let's say your gain is £50,000. You times that by 36%, and you pay tax on that amount. Does that make sense? Okay. But if you don't rent it out, okay, and stay in it, refurbish your new house, and then move out and sell it around about the same time, or take 9 months to sell it, no tax to pay. If you rent it out, depending on how long you rent it out for, you may have tax to pay at some point in the future. And the longer you've stayed in it, okay, the smaller this figure is going to be. The less time you've spent in it, and the more you rent it out, the bigger this figure is going to be. Yeah? Happy with that?
Yeah.
Your supplementary question. I'm not sure I want to hear it, but now that I'm in.
Okay, so what happens if you actually rent it out,
Yes.
the house,
Yeah.
the main residence,
Yeah.
for a number of years?
Yes?
And you move your main residence, are you then moving your main residence to the other place which you bought? And then when you are selling your first main residence, what happens to CGT?
Okay. Were you in the room for the last 5 minutes by any chance?
I think so. I may have been under the table.
Okay, so when you move your main residence, then your existing house, okay, may become chargeable to capital gains tax depending on what you do with it. So if you sell it, obviously no CGT to pay, like we said for David.
Yes.
Yeah. No, there's no 3-year business. Sorry, the 3 years was for David to get the stamp duty land tax back. So you buy a second home, you pay the additional 3%, claim back within 3 years. Okay. If you rent the house out, then like we said with David over there, if he's owned the house for 100 months, rented for rented for 36, so 36 into 100 is 36%. You work out what your gain is, and you pay 36% of the gain to HMRC for tax purposes.
But the gain is from the very beginning when you bought the house?
Okay, is this a real life example, by the way?
Yes, it's a
come on then. How much did you buy a house for?
100,000.
When did you buy it?
30 years ago.
Okay. And how long did you live in the house?
30 years.
Okay. And when are you buying your new home?
Now.
When are you moving into your new home?
Now.
Okay. When are you going to sell this home?
Not at the moment. So I want to rent it out. Maybe let's call it in 10 years' time.
Okay. So we're going to keep this really easy. So you're going to have the house for 40 years?
Correct.
You're renting it for 10 years?
Yes.
Okay. So you work out your capital gains tax at the time, and you pay 25% of that bill.
But when you say at the time, what does it mean?
It depends what the value is. So let's say you bought the house for 100 grand, and let's say in 10 years' time, how much is this house worth?
Say million, because it would be fair.
Call it median.
Okay, and we're going to keep the numbers really easy. Okay, ignore all of the costs like SDLT, legal costs, all that kind of stuff. You've made a £900,000 gain. Okay, you'd pay 25% of that in CGT. If you sell it now, no capital gains tax.
So you are not counting capital gains tax from the moment that house stops being your main residence. You go back to 40 years ago.
No,
rather than
we work out how long you've had the house for, and we work out how many years don't qualify. In your case, 10 years don't qualify because you were renting the home. So therefore, 25%, okay, is taxable. Therefore, 25% of that figure is taxable.
Okay. But do you need to how do you prove the value before you rent out?
The value when you rent out doesn't matter. The value only matters when you purchased it, when you sold it, and that's going to be on your...
And the number of years it was rented. Yeah, okay, thank you.
You happy with that? James?
There's also a couple of other deductions that I've had a similar situation recently. Isn't there £40,000 or up to £40,000 that also gets knocked off from that on top?
Yeah, we just try and keep it really simple over here. Okay?
It's unlikely you should pay any tax, though, if it's that ratio, isn't it?
It depends, because obviously if it's £900,000 and you're paying 25% of that, it's going to be about 235,000. So
Yeah, they'll be taxed.
yeah, so they will be taxed. Thanks for watching, and I hope you enjoyed this video. If you have, by the way, make sure you click like, subscribe, and post a comment because that tells me that you're engaging and you're finding the content useful. And if you like this video, make sure you check out this video here because it's the next stage in terms of your learning and development.